Um, Welcome, everybody. So today I'm going to take a topic known as corporate valuation. So, so in that corporate valuation, I'm going to take about discounted cash flow method. So it involves in forecasting the future cash flows for all time to come. That is, we are going to discount and see what is the future thing. Then discounting them will present the point of time using the cost of capital that reflects the capital firm's capital structure and business risk. So there are different valuation methods that is for to evaluate uh, different risk, that is a firm's capital structure and risk. We have various DCF models, that is the discounted cash flow methods. One is enterprise, equity, dividend, free cash flow. Under equity we have dividend and free cash flow, adjusted present value, and we have economic profit models. So adjusted present value model and economic profit model. So enterprise DCF model. It is an attention that emphasizes the acceptance in early 1990s because this method is conceptually superior and has gained strong endorsement from the leading consultancy organization like McKinsey and company. It draws a heavily book that is valuation, measuring and managing the value of the company. This value of the company is where we are going to project our forecast for the coming years. So here the DCF value approach is value from the identical similar of that of value capital. So project using value method, but there are two differences. One, project finite economic life of the project is defined at the end of its economic life salvage is imputed, but firm as an entity has an infinite life. Capital project are valued as one of the investment, but the firm as we consider is growing entity, all achieve investments is fixed and net working capital are expected to be made more time to sustain the growth and consider the value of the firm. Okay. Thus, the value of the firm can be present value of cash flow during the explicit period, present value of the cash flow after the explicit period is we are going to during the explicit period where we are going to find. So first we are going to find from, for example, if the company is there for the 4 years, it is projecting the high growth in like 4 years. Post to that, they wanted to project how they are going to project. That is a terminal value. Using the terminal value, you're going to project. So that is what you're going to find here. So steps. First one is analyzing the historical performance, estimating the cost of capital, forecasting the performance, determining the continuing value, and calculating the value and interpreting the skills. So first one, historical performance are analyzed to take the base for the future performance prediction. Since financial statements are not prepared with an intention to value the firm, analyze needs to rework the financial data to derive an economic performance instead of the financial performance. So historic data is actually need, that is for the base year. With the base year is what we are going to project the coming year. So that is a historical performances there. So they are telling that they always need to rework the financial data to derive the economic performance instead of seeing the financial performance. In this, they determine the net operating profit after tax and free cash flow. Estimating cost of capital. So cost of capital here what is the rate at which the investors are ready to invest and accept to invest, and it is a discount rate used for converting an expected free cash flow into the present value. So it represents the weightage cost of weightage average cost of capital. So when we are calculating the weightage average cost of capital, one we are going to calculate for the equity and one more for the debt, and here we are going to calculate for the current year and high period, and you're going to calculate for the stable period. Okay. Forecasting performance is the third step. Once the historical is analyzed, the financial forecast reflecting expected future performance of the company will be determined. Determine the length and explicit period. So for example, if I wanted to project for the 4 or 5 years, so I'm going to project for the 5 years. Post to that, what will be the terminal value? For that, we are going to calculate the free cash flow for the year, which means based upon the expected return that or expected percentage to increase over a period of time is what we are going to calculate. During the period, the company sees a rapid growth. After the explicit period, forecast period, firms expected to reach a steady state. That steady state is known as a terminal value. Okay, up to 5 years, it's going to be your high growth period. Post to that, you will have a terminal value is known as a stable growth period. So the base year, the high growth, and the stable period. In that, you're going to find what is your cash flow over a period of time, whether it's an increasing trend or a decreasing trend. Post that is where you're going to calculate your cost of capital. That is your weighted average cost of capital, in which the capital for the high growth period as well as for the stable growth period. Determining the continued value, forecast cannot be forecasted for 100 years. It is maximum for 5 to 10 years or to 15 years. It's not more than that you cannot forecast, because you don't know when the economy will fluctuate. The value after the explicit period is known as continuing value. So DCF valuation stage 2 and stage 3 growth models. So when we have problems, okay, when problems have a detailed year by year information which is permitted, and kind of variations in the items from year to year is not available. So only the base year's value you will have. From the base year's value, how much they are expecting to have a high growth over a period of time, and post to that the interest rate, whether it is a revenue rate, interest rate, all these rates will be depend. Only the base value will be given. From there, you have to find up to the year. That as we told, it is up to 5 to 10 or up to 15 years is where we can value the discounted cash flow can be done. So this is two stages are there. One is the two stage model and the 3-stage model. Thank you.